Thank you very much, Cara, for the introduction, and thank you, Exprim and Daniela, for having me this morning. So we are going to speak about our thoughts on ESG with taking the rating agency, putting our rating agency glasses on. So maybe just one thing to quickly mention before we start. So we are a rating agency specialized in the insurance industry. We are not issuing ESG rating, but ESG factors are a really important part when it comes to analyzing the financial strength of the insurance industry, and as such we integrate ESG factor in our financial strength analysis. This is disclaimer. So maybe just very quickly before we start, a quick summary of the ESG factors, so environmental, social, and governance. They are risks, but they are also seen as opportunities. I think most of us in this room are extremely familiar with ESG, so I will not spend a lot of time on this. And we are now going to look at the factor under a different shape. So first, what we saw is that there is an increased importance of the factors since the last years, and that companies overall are more and more aware of different ESG challenges. So the first pillar, the environmental pillar, relate to resource uses, to pollution, climate risk, energy use, waste management, and other environmental challenges and opportunity. So in these pillars, we're going as a rating agency to look at the effect that the environment can have on an insurance company's balance sheet. And what is interesting is that over the last months, we have seen an uptick in the influence we see of this block on certain insurers' balance sheets. So we have even seen some downgrades, so mostly located in North America, but tied to environmental factor. And generally in the case where there was a rating action tied to ESG and particularly to environmental problematics, it was mostly related to secondary perils and not to extreme catastrophic events. Then we have the social pillar, so related to how a company interacts with the community and with its ecosystem. So the two big factors we see on this block are mainly social inflation and problematics with data privacy. So for social inflation, historically, we have also seen a lot of influence of this factor in the US, with juries sentencing companies to record high fines, for example. We also see an effect of, for example, the changes in demographic, for example, with the way that insurers decide how they will address the fact that people are living longer. For example, this is a very, very important point, for example, for life insurers. And this can be a challenge for certain companies. And finally, the third pillar, which is maybe the pillar we are the most familiar with, is the governance pillar, which assesses the corporate governance. And here we will see different, very broad type of factors, such as board diversity, gender pay gap, hiring problematic, promotion practice, etc. So this is a block where we see generally the most upward trends, but we also see negative pressure sometimes on this block. So this is the effects that we see overall on the industry. So what is important to keep in mind is that it's not only about mitigating risks that are tied to this factor, but it's also about recognizing the good opportunities which can arise from the different factors. So now, if we're looking more specifically at investing activities, we see that a lot, and I would say the vast majority of companies that we rate are incorporating ESG criteria in their investment activities, and we see a broad range of different approach. So one of the most common approach which we see quite often is screening, so in particular negative screening. So this would mean, for example, that the company would be looking at excluding investing in industries which are not ESG compliant, for example, not investing in the coal industry or in oil and gas. So this is an extremely common approach that we see among a lot of insurers. Another approach that we see also quite much is ESG integration. So we see this more and more, and it consists that taking into account ESG issue when taking investment decision. So this allows the company to take better decision and better manage their risk, which are tied to ESG factor. And it's also helping in the decision process. And third thing that we see quite much is thematic investing. So this we mostly see at larger companies where there is, for example, pockets which would be allocated for green investments. So each year, a company would aim at investing a certain amount in so-called green product or specific sustainable assets. So these are the three most common approach that we see when it comes to investing in new securities. The second approach that there is working on the existing portfolio. And there we also see different things and two main approaches. The first approach is engagement. So generally companies would discuss with the companies they are investing in to try to influence them and try to make them take decisions that would make them more sustainable. So we see this on insurers with their own investment, but we can also see that there is an influence of insurers' shareholder in case of listed company for insurers to become greener and greener, and that there is an appeal of the market to be more sustainable, and this has resulted in insurers becoming more sustainable. The second approach that we see, and that we maybe see, that is maybe a little bit less common, is that insurers would use what is called proxy voting. So they would exercise their voting right in order to constrain the security to take a more sustainable approach and increase the ESG in securities. So during the rating process with the company we rate, we obviously discuss investments and ESG investing. And what we see is that even if most companies have ESG criteria in place, there is still different level of incorporation depending on the company, on the market they are intervening in, on their size, and generally there is not only one approach. So I've listed a few considerations that we heard about in various management meetings we have with companies. For example, some companies find it challenging to engage their stakeholder into the ESG journey. We see also that generally it's very crucial for company to choose their KPI related to ESG on a very careful way, and that there is very diverse sorts of KPI. For example, lowers the carbon footprint of the company, lowers the carbon footprint of the investment portfolio, and have a more efficient real estate investment, or simply show more exposure to green assets. So generally what we see is that when companies are making their commitments public, there is more action and maybe more result. Maybe they feel more that they have to hold it. Another thing that we hear a lot, and that has been highlighted in the previous discussions, for example, by Klima, is that there is still data quality problems when it comes to ESG. There is ongoing work, there is a framework that is going to come into place, but at the moment it's still sometimes a bit difficult to access good data quality. So there is although one other thing to consider is that certain insurers, and I think, for example, about the life ones, they are more long-term investors. They have to maintain a good level of diversity in their sector and not focus too much on one sector. This gives an extra challenge because what we have seen is, for example, if you take the utility sectors, then you can find a lot of green assets. But if you want to maintain a good level of diversification, then it can be challenging to maintain this level of diversification without being too concentrated on one industry in particular. So this is a challenge that we see also in the companies we rate. Maybe one thing to mention is that it's overall the ESG world is evolving very quickly. So we see that it's more and more taken into account. There is more and more development. And we see a lot of positive changes in the sector, and also a lot of companies manage to lower their carbon footprint, for example, and work on this. So maybe just on the right side of the slide, you can see the forces which drive responsible investment growth according to the UN PRI initiative. And what you can see on this graph is that the force driving the growth are generally not isolated, but they are intertwined between each other. So for example, an increased sustainability can increase client demand for ESG compliance security, and that everything is linked and not to be seen as a specific isolated matter. So maybe now I just wanted to highlight how we take into account the ESG factors I mentioned within our rating process. So as I just mentioned before, we are not rating ESG, but we are incorporating ESG factor in our financial strength assessment where they are relevant. So we work with what we call the building block approach, starting with evaluating the balance sheet strength of the insurance company, then going to operating performance, so seeing if a company's operating performance is going to reinforce the balance sheet strength or possibly weaken it, and then on top of this, the business profile, enterprise risk management, potentially there can be a comprehensive adjustment, and then also potentially what we call lift and drag, which is the influence, for example, a parent could have on an insurance company, and then you arrive to the rating. So within our building block approach, we expect that the ESG factors can impact multiple parts of the assessment. So environmental factors, and particularly climate risk, may be a threat to the balance sheet strength of a company. So it's especially true for property and casualty writers and reinsurers because of the potential material, rapid and unexpected impact of natural catastrophe. So we expect that insurers who are willing to accept weather-related catastrophe risk to be able to demonstrate that they can manage this risk and that they can potentially absorb losses. Asset risk is another factor, which can impact the balance sheet strength assessment of companies. So we are transitioning from a high to a low carbon economy. There is a potential to leave some insurers with exposures to assets which could become stranded. And it's something to keep into account, and it could potentially lead to write-downs if the company is not managing correctly. It could also lead to an impact on the operating performance block. There is also possible impact on the business profile. So for this block, we can think about, for example, reputational risk associated with ESG factor, particularly environmental. We can have scandals and potentially other consequences which would lower a company's possibility to get new business and to retain their existing customers. As an example of ESG-related scandal, we can think about, for example, privacy breaches, because insurers are collecting and keeping an enormous amount of data and information on their policyholder, and a data breach, for example, could erode the trust of policyholders in the insurer. This could also result in fines, for example, for the insurer. And then finally, there is ERM. So it's the corporate governance is clearly a key point for us. It's an element that is explicitly considered in our ERM building block, and we expect that insurers and reinsurers have to exhibit strong corporate governance practice to be able to better manage their risk, to be able to take opportunities, and that these insurers would get then less volatilities than insurers with a less mature risk management framework. So since 2020, credit rating agencies have to publicly disclose information related to rating action tied to ESG factor when they are the key determinant of a rating action. So this means that when there is an upgrade or downgrade, for example, or if there is a change in an outlook, we have to specify if this is tied to an ESG factor. So these are the different ESG factors which you can see, which we use to flag when there is a potential change. So the first one is natural catastrophe. Factor 2 includes also pollution, contamination with liability risk, for example, as well as investment portfolio problematics. Factor 3 would, for example, include social inflation. Factor 4 would include reputational risk, and factor 5 would include all the ERM related problems. So what is interesting, and what I mentioned earlier, is that we have seen recently an uptick in more rating action tied to social inflation, for example, even if it's more located in North America. And so finally, few examples of factors that can affect insurers. So we can think about internal and external pressure. So for example, how to monitor environmental exposure, internal, external transparency, for example. Generally what we see is that there are long-term challenges. So for example, how to remain attractive. These are also generally tied to strategical objective, and they are extremely important for the long-term viability of a company, because the viability can be affected by ESG challenges. There can be very important impact, for example, on the reputational level, as I was explaining earlier. And within the ESG movement, there is also a certain level of uncertainty tied to regulation, and with the fact that we are still in a developing, let's say, framework. I think we can expect to see over the future more clarity from regulators regarding, for example, the identification, the measurement and reporting that have to be done on ESG factors, and we expect that there will be further disclosure, further reporting for insurance companies. So, for example, in the last year, we have seen, I would say, for example, in France, climate stress tests. In the UK, also, there has been climate stress tests a few years ago, and there is more and more development ongoing for the sector. So this concludes my presentation on ESG. If you have remarks or questions, I'm happy to answer them.